Our day, we have, doesn't need any introduction, the former chairman of the Federal Reserve, Alan Greenspan, joining us, and this question and answer period will be moderated by my colleague Tom Keene. If the two of them want to join us up here on stage, Tom Keene, of course, is the host of Bloomberg Surveillance on Bloomberg Radio. He's of Surveillance Midday on Bloomberg Television. He is the hardest working man at Bloomberg. And Chairman Greenspan, thank you for the time today. We appreciate it. Tom, the stage is yours. Thank you for the time. And again, we will have some time, we hope, at the end for some questions from our audience, those watching at home. Tom, take it away.
Well, let me start in the wonderful conversations we've had the last few days. Let me quote from the Bible here. Wait, that's the age of turbulence. Page 483. I suspect it is likely that to restore policy sanity, we will first have to trudge through economic and political minefields before we act decisively. I'm looking to my right, Chairman, at Capitol Hill, where there's many minefields, and it is corrosive, isn't it?
I said that 4 years ago, and I guess I could still say it today. There's something very on in the political system, in the sense that it is quite correct that there's a huge divide between Republicans and Democrats, and if you're looking for the caucuses, the Senate and the House, Democrat, they are all basically single distributions with nothing in the middle of either the Senate or the House. And it struck me that this is probably unusual. But I went back and I looked at the data, and it is not. There are data which enabled you to construct the voting records and the individuals who were voting going all the way back to the first Congress. And what it shows is that this distribution, where you're getting, say, in the Republican caucus and then the Democratic caucus and nothing in between, that goes all the way back to 1850. That is not what the problem is. The problem is, despite the fact that we've had this bivariate distribution, up until very recently, there was always a capacity to reach across the aisle and come up with compromises. Because remember, it's in the nature of a democratic society in which we've all chosen to live together that compromise. And the question is, it's not a compromise of principles, but it's tactical compromises which enables legislation to change.
We found that capacity after November of 1963. We found that capacity in 1986 that you have been on. How do we get that capacity back? That, to me, is the fundamental question, but I think it's important to recognize what it is. The basic problem here is to recognize that compromise is implicit in a democratic society, and that unless you're going to do that, assuming you don't have supermajorities, which will work as it happens in the past. Could we get an election prediction out of you right now?
Yeah, it wouldn't be worth anything. No, my wife's in that business. I'm not.
Well, when you look at the politics, let's bring it to this fiscal cliff that we have at the end of the year. First of all, do we face a fiscal cliff?
Well, legally, yeah. I mean, obviously, we looked very far to find out that there was a huge fiscal cliff out there, and it's basically the result of kicking the can down the road. People, and this is part of what the current environment is, don't wish to inflict pain on anybody under any circumstances. And the problem is, we're not going to get out of this both political and economic mess in which we exist without some pain. There's just no credible scenario which does that. And the endeavor on the part of Republicans and Democrats, as soon as an issue comes up where somebody is against it, they back away. That was never how we functioned in this country. And unless we break that habit, I think we're in trouble.
Well, we had Bowles-Simpson. I heard Secretary of the Economic Club of New York just hesitate as he suggested we would get back to Bowles-Simpson. Are you optimistic that we can revisit a form of the work of Domenici and Rivlin or the work of Bowles and Simpson? Can we revisit that after the election?
I remember saying, I think it was on one of the Sunday morning shows, it's probably Meet the Press, the day after Simpson-Bowles came out. And I said, something of this nature, or this bill, no, I know what it was. I was asked whether or not I the House and the Senate. And I said the answer is yes, it's only a question of whether it occurs before or after a bond market crisis. I still hold to that view. I think the worst mistake made was not embracing that particular vehicle right away, because there are very few initiatives which have the wonderful capability of getting Republicans and Democrats on board exact legislative language interpreted differently. I mean, what's in the Bowles-Simpson initiative is $1 trillion in tax expenditures. Now, tax expenditures to Republicans are subsidies, and eliminating them is an excellent political maneuver. For Democrats, it's an increase in taxes on the rich. Now, you can't get it better than that for getting some form of legislative compromise. And basically the Ryan Wyden amendment to Bowles-Simpson, which addresses Medicare where it wasn't addressed. I mean, it's a bipartisan. I mean, Ron Wyden's a Democrat and Paul Ryan is obviously a Republican. It's the ideal vehicle which won't get us fully out of this. I mean, it would have when it was originally offered.
In the back end of Age of Turbulence, where you write of the future, you center on 2030, and you show higher yields and lower bond prices on a path to 2030. You mention a bond crisis. Somewhat the tone I hear there is you would find a bond crisis to be constructive for Washington, even as it could be destructive for our retirement plans and for New York. Why haven't we seen it now? And is Brad DeLong of Berkeley and Krugman of Princeton, are they correct? Look, interest rates are low. There isn't a crisis. I just want to get you going this morning.
Interest rates are low before they go up. I mean, look, at the top of any speculative boom, none of the bond market's a speculative boom, you'll always find that just before the top, which historically is the top, bids outrank offers of that particular product very significantly. And all you have to do is remember 1979. Remember it vividly, that the Treasury, I think the 10-year note had gotten up to 10% yield, and the general consensus at that point was the United States is not an inflation-prone economy. This is as far as it can get. The next 3 months it went up 400 basis points. You cannot anticipate changes. In other words, basically to say that make a historical statement, namely that interest rates have been low, that therefore stay low, that is not a syllogism.
Well, critically here, and it does link into Fed policy, and I know you don't speak of Fed policy after 2006, do you envision, given your historical study, that when we get higher interest rates, it will be sudden, abrupt, a jump condition, be a glide path that any institution, including a central bank, can get out in front of?
The general view of market participants and investors, and indeed this was the case in basically 2007, 2008, it wasn't that investors, basically the professional investors, the institutions and the like, weren't aware of the fact that there was potential instability there, but remember Citigroup's Prince making a statement that everyone must keep dancing until the music stops. And what the problem is that nobody could move their portfolios out for fear of losing competitive position. Mm-hmm. And they all thought that because of the huge in the market. I mean, it's you were getting huge liquidity on synthetic CDOs of all things. Mm-hmm. You couldn't supply enough of them, and so that the general view amongst most investors, well, we will have time to get out of the stop, so to speak. They were wrong, because when liquidity disappears, it doesn't disappear incrementally. It disappears suddenly. And this is what I think we have to confront. I don't have a clue when, or in fact, if it's going to happen. I grant there is a definite possibility that when one thing I can say for certain, that interest rates will rise over the next 10 years. 10 years from now, or on average, it will be higher. I would say that for 5 years, and if you kept pushing me, I'd move it in closer. But markets don't behave in the simple way we'd like them to behave.
Our viewers, our listeners, the people here in the audience, we're all buying bonds. There's no question the bond flows now. This earlier, before we move on to another topic, are we in a bond bubble right now where we see the asset flows in just extraordinary, and we need to get an equity prediction from you? Does that mean that stocks are cheap?
Well, stocks are very cheap. All you have to do is look at the equity premium. The best estimate of the equity premium, as best I can judge, is J.P. Morgan's. That's at the highest level in 50 years. And that essentially means that with earnings still moving up, at least they have up until very, very recently, when against a very high equity premium, or in its more simple configuration, a very low price-earnings ratio, there is no place for earnings to grow except into stock prices. And I've been making recently and expounding on it, is I think we are underestimating the extent of equity stimulus as distinct from fiscal stimulus in driving this economy.
And you wrote about this in the FT, I believe it was, a few years ago, the need for good equity markets. And that's been more of an effect here than what we've seen from Capitol Hill?
Yeah, I think that we don't recognize how important the equity markets are in a market economy. I mean, we lost globally during the crash $5 trillion in listed corporation value. Equity is the collateral of the financial system. It's not only the equity amounts, but it's also the fact that where equity prices are essentially tells the bondholder how much buffer is there between what he holds and bankruptcy. And the bigger the market value increase in equity, the greater the quality, other things equal, of what bonds are. So, I mean, for example, you could have a corporation with technically a BBB yield, and then the equity price doubles, and the equity buffer rises, and what does it do? It improves it raises B to maybe a AA or something like that. So equities play a hugely important role, which I think is grossly underestimated. And one of the things that I'm working on is trying to estimate historically and do a little econometrics on this as to what the relationship of basically equities and equity premiums are in the real economy. Now, we do have this discussion of the so-called wealth effect, but that relates mainly in most of the discussions to consumer expenditures. It's a far broader, and I think that what we'll find is every time stock prices rise, especially in the context of very high equity premiums, you see a fairly quick response, obviously, not only in equity prices, but in the economy.
I want to get, but I want to squeeze this in because it is the debate of the moment. And we see Olivier Blanchard at the IMF talking about a need to reflate. We see others, Paul Krugman and others, talking about one form of stimulus is to get out front and reflate the economy. What does it mean to Alan Greenspan?
It means somebody else is lending you money, and your debt is rising. And if you think in terms of the issue, for example, this big debate that is now going on in Europe, where they're now talking about pulling back the austerity issues, I have no objection about doing that, but you have to remember that to the extent that you're pulling back on austerity, somebody else has to fund the gap that still exists. Pulling back from austerity, it essentially means that the ongoing deficits, pretty much across the whole spectrum of the 17 Eurozone countries, opens up. But that means somebody's got to fund it. Up till now, what's essentially happened, all the various alphabets of the various different vehicles which are being used to fund this, it's essentially the European Central Bank, which is doing virtually all of it. And what that means is that the ECB asset levels are rising significantly. And the fact that they're able to do that is that we have global economy which is partially stagnant and will continue to do so, largely because I think the degree of risk aversion is so high that you cannot get a growth rate going more in the United States, for example, than 2.5%.
To our viewers and listeners that don't have the sophistication of the interdependencies of these institutions and the movements, the answer point, as you mentioned, Mr. Prince, the dancing stops, the music stops, and you have to sit down and find the chair. If the ECB continues to provide liquidity, where's their chair? How do we clear or finish off the crisis in Europe? Financial liquidation and massive consolidation.
Well, remember, the ECB is supplying the chairs. That's what it's doing.
So we get endless chairs.
Well, but so far, I mean, and this is giving, I must admit, I mean, you go speak to my friends at the Bundesbank about a lot of what's going on. Look, looking back at history, you just do not get this type of very substantial expansion in the monetary base, if you want to put it that way, without ultimately triggering inflation. The only problem, basically, in forecasting is it can go on for years. In the end, it happens at the most, it changes in the most inconvenient time. And I don't see essentially how we're going to get through the European situation at this stage, because right at the moment they're caught in a very deep dilemma where they are fully aware of the fact. I mean, the people at the European Central Bank, I mean, the Maastricht Treaty is essentially a clear-cut vision of what that bank is supposed to do and not supposed to do. You have the language has got to get awfully fluid to reconcile what their actions currently are, and everyone is uncomfortable. All have Mr. Prince's view of what can happen or hope. You know, we don't. You know, everyone likes to say, well, we should put off the actual tough adjustments until the economy can take it. There's a presumption in that statement that the markets will allow us to do that. And I'm fearful that the markets are going to say no at precisely the most inconvenient time.
Those markets, as you personalize them, are they vigilantes?
Yeah.
When you look Europe, and you and I have talked about this in a number of times we've spoken and met, you continue to go back to what I call cultural economics, not the purity of model making or behavioral economics of Bob Schiller up at Yale as he searches for a good society. Culture in Europe is different than in America. Give us the nuance there, not only of peripheral Europe, but of Eastern Europe, as they try to amend to the culture of Germany.
Well, look at East and West Germany. Essentially two countries starting at the end of World War II, essentially from scratch. And same language, same culture, same history. And they grew up, obviously, and when the Berlin Wall came down, the productivity level in East Germany was 1/3 that of West Germany. And then when the merger occurred, there was the recognition that it was going to take a significant transfer of funds from West Germany to East Germany to maintain the system. That flow is still going on. It hasn't fully come together. In Europe, it's even a broader, more difficult problem. I did an op-ed piece for the Financial Times, it's maybe 6 months ago, and I also done published several different places, which really takes the issue of observing that when, as I recall, I used to sit in on the meetings which formed the European Central Bank. I was sort of part of the G7, and I would be sitting between all these Europeans and trying to... When they talk
Were you successful?
No. I never have been. At least my wife tells me I'm never successful. But the problem basically is that there was a general expectation within the group before the euro began, recognition that there are cultural differences, but the conventional wisdom was that when the euro actually was implemented, the Italians would behave like Germans. They never did, but the markets believed they would do it. As I recall it, the lira sovereign note, 10-year note, yielded 500 basis points over the Bund 2 or 3 years before the euro went into place. By the time they actually moved into the euro, that spread had gotten down to 20 basis points. So that the markets believed that culture would be coalesced, enforced by the existence of a common currency. Regrettably, they were mistaken. And what we have found is that it was a global boom, the euro system together, but once the boom let down, then culture reemerged in a massive way, and we're seeing the consequences of that.
Because of time, we could talk on this for hours, but because of time, I want to move on. You and your non-retirement have been looking at assets. What is an elderly assets?
This is my explanation of why the American economy is stagnant.
So the things that we talk about in the media right now are off the mark?
I think so.
Thank you.
You're welcome. You have to ask yourself, what is wrong with the American economy? And you can basically look at the gross domestic product, and instead of looking at it as personal consumption expenditures and a variety of other things that it is, look at it in terms of how long that which is spent will last. In an extreme case, a haircut lasts a month. The software will last 3 to 5 years. Structures, industrial structures, 30 years. Residential, longer than that. All of the weakness in the American economy from where you would expect it to be at this stage is in assets whose life expectancy or durability is greater than 20 years. And what that is if you think structures is roughly 7 or 8% of the GDP, and you cut it in half, you've got 3 to 4%. those 3 to 4 percentage points actually translated into the unemployment rate explains the whole difference of what jobs is. And the problem here is that the assets under 20 years are behaving pretty much the way they always have in every recovery in the post-World War II years.
Do we need government policy to clear the market for those longer age assets or to incentivize the building of those assets?
I think they've tried to do too much and it's been counterproductive. What you need is, look, before I got into government, I used to do a lot of work for in capital investment projects. And what we used to do is we'd get the product managers and they'd give us a forecast of a new product they needed. Finance people would estimate the average expected return. And as a result of that, we quickly blew out all potential projects which didn't earn the hurdle rate of return of the corporation. But that then moved you to step 2, which is really the big determinant, which is what is the variance, the spread of range over expected outlooks. For example, if you're expecting an average rate of return of 20%, but it varies between -10 and +50, that project was invariably shelved. And what we're looking at right now, and the reason why we've got a particular shortfall in economic activity and specifically in long-term investments, is if you look at the cash flow of American corporations and the proportion they choose to invest in long-term illiquid assets, that ratio is at the level since 1935.
Is that investment going abroad? Is the issue here that within all of our studies of crisis and recovery from crisis, we're dealing with not only globalism, but a reaffirmation of investment pushed abroad?
Very little. I mean, investment has been rather well in American affiliates abroad, but it hasn't accelerated, and you cannot very readily take the orders of magnitude that we're looking at changes in the United States and in any way ascribe them to being shifted abroad.
If I look at the medical duration of unemployed, or I look at the U6 unemployment, these spikes up that we've seen, they would tend towards less educated individuals. How would they fit into an incentivizing a business to make those structures? The answer is we've missed a lot of construction jobs, is it?
It's not only construction jobs, which obviously are a very substantial part of the job loss, but it's all of those secondary and tertiary related issues. Because remember, when you bring the level of building down by half, it has an impact on the whole Keynesian multiplier, if you want to put it in those terms. So it shows up as unemployment not only in construction, but in a whole series of other industries whose general level have been brought down by the fact that construction's impact on income and then consumption and other investment has been so powerful a force.
How do you propose that we jumpstart this so we start building structures?
I think the first thing we do is stop doing what we're doing. Let the markets calm down, and I think the endeavor to actually try to support markets is counterproductive. When you have an unbalanced market, any type, whether it's stocks, bonds, copper, zinc, whatever, that market will readjust one way or the other. If you try to support it, really delay the adjustment process. I think it's instructive. One of the only areas in which we endeavor to support we have not endeavored to try to support prices or values in one way or the other, the stock market. The stock market is the particular area of the economy which has been untouched and which has come back the most. And it is not an accident. I think that we have to learn sometimes leaving things alone. Markets work is the way the system is supposed to function and the way it has and will.
If we can tread delicately on monetary economics without asking you when the Fed will raise a target rate, I was talking to Steve Roach the other day of Yale University, formerly with Morgan Stanley, the asymmetric challenges that any central bank faces. And as you wonderfully quote in your book, you did not receive many phone calls from politicians or presidents looking for you to raise interest rates. It's a substantially asymmetric that any central bank works in. How do you fold the asymmetric realities into the desire for inflation targeting?
Well, first of all, what I actually said was that in all of my years, I got bushels full of mail. I cannot recall a single request from the Congress or any other political figure which said raise rates. Every single one of them. So it wasn't even asymmetric. It was just 0 and plus. That's still the case basically because the political system seeks the short-term solution and the fending off of any semblance of pain. You cannot run a complex capitalist society in which the average age of assets is 20, 25 years with everything being short-term. And there are occasions when the wise thing to do is to allow markets to liquidate. And I think the best example I can give is the actual experience that we had in Trust Corporation. I was on the oversight board ex officio, and as a result, I had to sit in on all those meetings. And I must admit they did a hell of an interestingly good job, which I don't think we could do today. What they did was, the 800 S&Ls failed back in, 20, 30 years ago. All the assets fell to the Resolution Trust Corporation to get rid of. Well, it was easy to get rid of the mortgages and all the liquid assets. But then there was this very large chunk of assets, which were 15-hole golf courses, 40-story skyscrapers, of which 8 have been built. And we could see the erosion, the maintenance costs of maintaining all of this stuff away, and always seeing our taxpayers' dollars going down the drain. What they chose to do was to bundle all of this stuff in billion-dollar groups, and $1 billion back then was a lot of money, and they hit the market. They just basically said, we're going to, and of course we expected 50 cents on the dollar, and that's what we got. Actually got even less than 50 cents on the dollar.
Why can't we do that now?
Well, basically because what happened back then is the Congress was up in arms, but one very interesting thing happened. All of the people are looking at this process whereby these vulture funds had bought cheap, and all of a sudden were making a ton of money.
So the incentives kicked in.
Well, what happened is that immovable inventory of unsaleable assets in a matter of months. And I think that particular action by the RTC probably saved American taxpayers a very large amount of
Could
money.
we do that today to clear our housing mess?
It would work, but I see no evidence of any willingness on the part of either party to move in that direction.
You nicely got away from monetary economics and Fed discussions there. You migrated away.
Really?
Yes, you did a very good job of migrating away. Let's get back to central bank policy. Central bankers have been texted. Philip Hildenberg today in an op-ed talks about the task of central bankers being arduous. In the path forward for central bankers, do they need to say to other institutions, no, we at the ECB aren't going to do this, you're going to find the courage to do this? Alberto Alessi talks about this. He writes about it. We need institutional courage. Do the central banks just have to say no someday to the task at hand?
Basically, central banks were prohibited from doing certain types of things. And, yeah, I would say that there are certain things which ought to be done by governments, not by central banks. I mean, for example, one thing that I thought was very unfortunate is that when the interventions of 2008 occurred, which is these once-in-a-100-year events which requires that sort of action, the only vehicle available to act quickly was Fed's actual legal authority to lend virtually to anybody at conditions. It was an amendment to the Federal Reserve Act which was very rarely used, and it was the only vehicle that would enable a quick response to occur. And so the Federal Reserve, as the fiscal agent of the Treasury, accumulated lots of assets on its balance sheet, and what I had hoped was going to happen very quickly is that the Treasury would take over those assets onto a Treasury subsidiary.
And they didn't.
They didn't launch. Would have required the appropriated funds, which is ridiculous because it's one of the flukes in the unified budget accounting system in which if it is an expansion or loan by the Federal Reserve, it does not require funds. But exactly the same use of sovereign resources by the Treasury does. And the only difference of whether the assets are held on the Federal Reserve or on the Treasury's balance sheet is the fact of the accounting procedure, period. The inability or unwillingness of the Treasury Department to go up to the Hill to get appropriations for that is what created a big problem for the Federal Reserve, because they were literally then involved very obviously in fiscal actions, which is not what the central bank should be.
You and others, but you in particular, have been criticized for not raising rates in 2003-04, I'm guessing. Jeffrey Lacker, among others, says in 1994 you did get out in front with preemption. When you see the debate, not the Fed, but the global central bank debate today about when we raise interest rates, what data, and you as a great student of data, what data should any central bank study as to know when to raise interest rates?
Well, it is of necessity involved in a forecast. All central bank actions presuppose an outlook which you are addressing, because obviously the impact of monetary policy drags out over time, and you have to try to infer what's going on. In other words, the issue of the question of our lowering rates in 2003, which we did, and I think was the right thing, I still think it was the right thing to do, is insurance against the type of deflationary forces we're looking at now. But it never had any on the money supply. It had zero impact on long-term rates and had no effect whatsoever in retrospect that I can see. And even such a student and critic, actually, of the Federal Reserve, Milton Friedman, said that the performance from 1987 to 2005 was extraordinary and excellent.
But did it fuel the leverage that led to this housing boom?
No, I think the housing boom comes out of a different force. It was interest rates, low interest rates, that induced the housing boom, but it was long-term interest rates, because remember, housing is a long-term asset and the mortgages are long-term. It is not affected by overnight rates. And indeed, what caused this extraordinary housing boom, the remarkable change that occurred after the fall of the Berlin Wall. And all of these very large so-called third world countries, which are under one form of socialism or another,
had to buy the long-term paper.
Well, now what they did is they essentially, looking at what happened to the Soviet system, they switched, and China became the most capitalist economy in the world. And the extent of the growth in China is really a tribute to capitalism, if I may put it that way, for a very odd Chinese communist government. But effectively, what that essentially was doing was creating a huge increase in income. Remember that the rate of increase in the developing world's GDP after the, 91, 92 forward, and especially from 2000 forward, that was a huge increase in the developed world's GDP, which got so large they couldn't spend it. So it was all savings which went into the marketplace and pushed down globally.
75 basis points? Just as a
no,
just
no,
rule
it
of thumb?
was far more than that. What it was, however, it's important to recognize, is the housing boom is not an American phenomenon. We were sort of somewhere in the middle. I mean, there were all which had big housing booms, and the question is not it's got nothing to do with the United States.
I want to squeeze in one question. I know Peter Cook has some questions as well. I believe there's a job opening at the Bank of England. Everybody else seems to be Jim O'Neill and others considered to be the governor of the Bank of England. Would you accept the job if it was brought up now?
I would ask the current governor, who's a good friend and an extraordinarily good central banker, to stay in place. Sir Mervyn is doing an excellent job.
Very good. Peter, your question.
A few great questions submitted to us. I'll try and squeeze at least one or two in here if I can. Movements out on the risk curve are obvious as people search for yield, and the potential for wealth destruction is very real as buyers are truly not being aware. As rates rise, doesn't the bursting of the bond bubble have the potential to be much broader than the 2000 market implosion?
Oh, it's extraordinarily difficult to get something which was worse than the impact on the market that followed September the 15th, 2008. And as far as I can see, prices inherently cannot move like equity prices can move, and so that the sizes of the capital gains and losses just cannot be equivalent in that respect. That is not to say you cannot have a real rupture. I mean, I think if you're going to look for the criteria, what type of things we're looking at, go look back at 1979, 1980.
Let me squeeze one more in here, and this is a quote that I'm reading submitted. This is the shabby secret of the welfare statist tirades against gold. Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious as a protector of property rights. If one grasps this, one has no difficulty in understanding the statist antagonism toward the gold standard. The writer suggests that you wrote these words some 45 years ago at the end of an essay entitled Gold and Economic Freedom. Looking back over 45 years, could you give us your thoughts on that essay today?
I thought it was very perceptive myself.
Did Ron Paul write that question?
That was not submitted by Ron Paul.
No, look, in fact, I had a very interesting conversation with Ron Paul when he was complaining, this is a House hearing, Reserve, should be going back on the gold standard. And I said, look, the American people have chosen to have a fiat money standard because they want a welfare state. You cannot have the gold standard and the welfare state at the same time. And you have to make the choice. And we have made a decision as a society that will be dealing with the welfare state. Now, I also told them, I said, the normal practice of a central bank is to replicate the actions essentially that the gold standard used to do when it controlled this is the gold standard before 1, not subsequently. And I think the markets today are telling us something very important, namely that gold is a currency, and it is the fiat money currencies by necessity have to be a game. But gold is the only one of them that doesn't require somebody's credit to authorize it. There's no name associated. Gold is acceptable for reasons in all of the years I never fully understand. What is there about human nature which attaches itself to this particular single metal that goes back to antiquity, and it has never changed.
I've asked my wife that question, in fact.
What did she say?
Chairman Greenspan, thank you very much for the time. Tom, great job as always. This conversation will continue on Bloomberg Television in just a few moments. So, again, thanks very much. We do want to move on to our...
Same language, same culture, same history. And they grew up, obviously, and when the Berlin Wall came down, the productivity level in East Germany was 1/3 that of West Germany. And then when the merger occurred, there was the recognition that it was going to take a significant transfer of funds from West Germany to East Germany to maintain the system. That flow is still going on. It hasn't fully come together. In Europe, it's even a broader, more difficult problem. I did an op-ed piece for the Financial Times, it's maybe 6 months ago, and I also done published several different places, which really takes the issue of observing that when, as I recall, I used to sit in on the meetings which formed the European Central Bank. I was sort of part of the G7, and I would be sitting between all these Europeans and trying to... When they talk
Were you successful?
No. I never have been. At least my wife tells me I'm never successful. But the problem basically is that there was a general expectation within the group before the euro began, recognition that there are cultural differences, but the conventional wisdom that when the euro actually was implemented, the Italians would behave like Germans. They never did, but the markets believed they would do it. As I recall it, the lira sovereign note, 10-year note, yielded 500 basis points over the Bund 2 or 3 years before the euro went into place. By the time they actually moved into the euro, that spread had gotten down to 20 basis points. So that the markets believed that culture would be coalesced, enforced by the existence of a common currency. Regrettably, they were mistaken. And what we have found is that it was a global boom, the euro system together, but once the boom let down, then culture reemerged in a massive way, and we're seeing the consequences of that.
Because of time, we could talk on this for hours, but because of time, I want to move on. You and your non-retirement have been looking at assets. What is an elderly assets?
This is my explanation of why the American economy is stagnant.
So the things that we talk about in the media right now are off the mark?
I think so.
Thank you.
You're welcome. You have to...
Europe, and you and I have talked about this in a number of times we've spoken and met. You continue to go back to what I call cultural economics, not the purity of model making or behavioral economics of Bob Schiller up at Yale as he searches for a good society. Culture in Europe is different than in America. Give us the nuance there, not only of peripheral Europe, but of Eastern Europe, as they try to amend to the culture of Germany.
Well, look at East and West Germany. Essentially two countries starting at the end of World War II, essentially from scratch. And same language, same culture, same history. And they grew up, obviously, and when the Berlin Wall came down, the productivity level in East Germany was 1/3 that of West Germany. And then when the merger occurred, there was the recognition that it was going to take a significant transfer of funds from West Germany to East Germany to maintain the system. That flow is still going on. It hasn't fully come together. In Europe, it's even a broader, more difficult problem. I did an op-ed piece for the Financial Times system together, but once the boom let down, then culture reemerged in a massive way, and we're seeing the consequences of that.
Because of time, we could talk on this for hours, but because of time, I want to move on. You and your non-retirement have been looking at assets. What is an elderly assets?
This is my explanation of why the American economy is stagnant.
So the things that we talk about in the media right now are off the mark.
I think so.
Thank you.
You're welcome. You have to ask yourself, what is wrong with the American economy? And you can basically look at the gross domestic product, and instead of looking at it as personal consumption expenditures and a variety of other things that it is, look at it in terms of how long that which is spent will last. In an extreme case, a haircut lasts a month. The software will last 3 to 5 years. Structures, industrial structures, 30 years. Residential, longer than that. All of the weakness in the American economy from where you would expect it to be at this stage is in assets whose life expectancy or durability is greater than 20 years. But one very interesting thing happened. All of the people are looking at this process whereby these vulture funds had bought cheap and all of a sudden were making a ton of money.
So the incentives kicked in.
Well, what happened is that immovable inventory of unsaleable assets in a matter of months. And I think that particular action by the RTC probably saved American taxpayers a very large amount of
Could
money.
we do that today to clear our housing mess?
It would work, but I see no evidence of any willingness on the part of either party to move in that direction.
You nicely got away from monetary economics and Fed discussions there. You migrated away.
Really?
Yes, you did a very good job of migrating away. Let's get back to central bank policy. Central bankers have been texted. Philip Hilderman today in an op-ed talks about the task of central bankers being arduous. In the path forward for central bankers, do they need to say to other institutions, no, we at the ECB aren't going to do this, you're going to find the courage to do this? Alberto Alessi talks about this. He writes about it. We need institutional courage. Do the central banks just have to say no someday to the task?
There was a general expectation within the group before the euro began, recognition that there are cultural differences, but the conventional wisdom was that when the euro actually was implemented, the Italians would behave like Germans. They never did, but the markets believed they would do it. As I recall it, the lira sovereign note, 10-year note, yielded 500 basis points over the Bund 2 or 3 years before the euro went into place. By the time they actually moved into the euro, that spread had gotten down to 20 basis points. So that the markets believed that culture would be coalesced, enforced by the existence of a common currency. Regrettably, they were mistaken. And what we have found is that it was a global boom, the euro system together, but once the boom let down, then culture reemerged in a massive way, and we're seeing the consequences of that.
Because of time, we could talk on this for hours, but because of time, I want to move on. You and your non-retirement have been looking at assets. What is an elderly assets?
This is my explanation of why the American, at the top of any speculative boom, none of the bond market's a speculative boom, you'll always find that just before the top, which historically is the top, bids outrank offers of that particular product very significantly. And all you have to do is remember 1979. Remember it vividly, that the Treasury, I think the 10-year note had gotten up to 10% yield, And the general consensus at that point was the United States is not an inflation-prone economy. This is as far as it can get. The next 3 months, it went up 400 basis points. You cannot anticipate changes. In other words, basically to say that make a historical statement, namely that interest rates have been low, that therefore stay low, that is not a syllogism.
Well, critically here, and it does link into Fed policy, and I know you don't speak of Fed policy after 2006, do you envision, given your historical study, that when we get higher interest rates, it will be sudden, abrupt, a jump condition, be a glide path that any institution, including a central bank, can get out in front of?
The general view of market and its costs, of maintaining all of this stuff, away and always seeing our taxpayers' dollars going down the drain. What they chose to do was to bundle all of this stuff in billion-dollar groups, and $1 billion back then was a lot of money, and they hit the market. They just basically said, we're going to, and of course we expected 50 cents on the dollar, and that's what we got. Actually, we got even less than 50 cents on the dollar.
Why can't we do that now?
Well, basically because what happened back then is the Congress was up in arms, but one very interesting thing happened. All of the people are looking at this process whereby these vulture funds had bought cheap and all of a sudden were making a ton of money.
So the incentives kicked in.
Well, what happened is that immovable inventory of unsaleable assets in a matter of months. And I think that particular action by the RTC probably saved American taxpayers a very large amount of
Could
money.
we do that today to clear our housing mess?
It would work, but I see no evidence of any willingness on the part of either party to move in that direction.
You nicely got away from monetary economics and Fed discussions there. You migrated away.
Really?
Yes, you did.
Language interpreted differently. I mean, what's in the Bowles-Simpson initiative is $1 trillion in tax expenditures. Now, tax expenditures to Republicans are subsidies, and eliminating them is an excellent political maneuver. For Democrats, it's an increase in taxes on the rich. Now, you can't get it better than that for getting some form of legislative compromise. And basically the Ryan Wyden amendment to Bowles-Simpson, which addresses Medicare where it wasn't addressed. I mean, it's a bipartisan. I mean, Ron Wyden's a Democrat and Paul Ryan is obviously a Republican. It's the ideal vehicle which won't get us fully out of this. I mean, it would have when it was originally offered.
In the back end of Age of Turbulence, where you write of the future, you center on 2030, and you show higher yields and lower bond prices on a path to 2030. You mention a bond crisis. Somewhat the tone I hear there is you would find a bond crisis to be constructive for Washington, even as it could be destructive for our retirement plans and for New York. Why haven't
press the day after Simpson-Bowles came out, and I said something of this nature or this bill. No, I know what it was. I was asked whether or not I the House and the Senate, and I said the answer is yes. It's only a question of whether it occurs before or after a bond market crisis. I still hold to that view. I think the worst mistake made was not embracing that particular vehicle right away, because there are very few initiatives which have the wonderful capability of getting Republicans and Democrats on board exact legislative language interpreted differently. I mean, what's in the Bowles-Simpson initiative is $1 trillion in tax expenditures. Now, tax expenditures to Republicans are subsidies, and eliminating them is an excellent political maneuver. For Democrats, it's an increase in taxes on the rich. Now, you can't get it better than that for getting some form of legislative compromise. And it's an increase in taxes on the rich. Now, you can't get it better than that for getting some form of legislative compromise. And basically the Ryan Wyden amendment to Bowles-Simpson, which addresses Medicare where it wasn't addressed. I mean, it's a bipartisan. I mean, Ron Wyden's a Democrat and Paul Ryan is obviously a Republican. It's the ideal vehicle which won't get us fully out of this. I mean, it would have when it was originally offered.
In the back end of Age of Turbulence, where you write of the future, you center on 2030, and you show higher yields and lower bond prices on a path to 2030. You mention a bond crisis. Somewhat the tone I hear there is you would find a bond crisis to be constructive for Washington, even as it could be destructive for our retirement plans and for New York. Why haven't we seen it now? And is Brad DeLong of Berkeley and Krugman of Princeton, are they correct? Look, interest rates are low. There isn't a crisis. I just want to get you going this morning.
Interest rates are low before they go up. I mean, look, at the top of any speculative boom, bond market's a speculative boom, it was an amendment to the Federal Reserve Act which was very rarely used. And it was the only vehicle that would enable a quick response to occur. And so the Federal Reserve, as the fiscal agent of the Treasury, accumulated lots of assets on its balance sheet. And what I had hoped was going to happen very quickly is that the Treasury would take over those assets onto a Treasury subsidiary.
And they didn't.
They didn't launch. Would have required the appropriated funds, which is ridiculous because it's one of the flukes in the unified budget accounting system in which if it is an expansion or loan by the Federal Reserve, it does not require funds. But exactly the same use of sovereign resources by the Treasury does. And the only difference of whether it's the assets are held on the Federal Reserve or on the Treasury's balance sheet is the fact of the accounting procedure, period. The inability or unwillingness of the Treasury Department to go up to the Hill to get appropriations for that is what created a big problem for the Federal Reserve, because they were literally then indeed what caused this extraordinary housing boom. The remarkable change that occurred after the fall of the Berlin Wall, and all of these very large so-called third world countries which are under one form of socialism or another
had to buy the long-term paper.
Well, now what they did is they essentially, looking at what happened to the Soviet system, they switched, and China became the most capitalist economy in the world. And the extent of the growth in China is really a tribute to capitalism, if I may put it that way, for a very odd Chinese communist government. But effectively what that essentially was doing was creating a huge increase in income. Remember that the rate of increase in the developing world's GDP after, 91, 92 forward, and especially from 2000 forward, that was a huge increase in the developed world's GDP, which got so large they couldn't spend it. So it was all savings which went into the marketplace and pushed down globally.
75 basis points, just as a
no,
rule of thumb?
no, it was far more than that.